Good evening, guys. How is everybody doing? Yeah, drop in the comments, make sure in the chat box, let me know if you can hear me, see me, and everything is all good as expected. Probably just give it another minute or so, let everybody else get on, and then we'll pick things up and get started. Yeah, so just do a thumbs up if you can hear me in the chat box. Yeah, perfect. Cheers, Colin. Also, so if at any point you've got any questions at all, yeah, just drop them in the chat box or in the Q&A box, and we will go through all of those at the end. So I've allocated quite a bit of time for any questions you might have. Perfect. So let's share screen and let's get this started. Yeah, so firstly, thank you very much for taking the time out on a sunny Sunday evening to be with me here and learn about accounting, tax, limited companies, and so on. So in this webinar, it's going to be quite broad in what we're going to try and cover a little bit of a lot. In that, we're going to run through kind of how to set your company up, some key errors that we see people make, and also how limited companies are taxed, what kind of forms need filling in, and essentially busting through all of the jargon that you see at Companies House, so you know exactly what the information of Companies House actually means. And on top of that, we're going to run through some key tax basics, so what expenses you can claim, directors' loan accounts, and quite a bit more as well. So what we'll do is we will just get stuck straight in now and take things off. So the first thing is, introduction to limited companies. So a limited company is the most common structure for tax reasons at the moment. Plus, you've got the limited liability benefit as well. The reason for this is a limited company is a completely separate legal entity. So if you're trading in your own name or a partnership, that you can be personally responsible for any wrongdoings, any debts of those. Your assets are personally at risk. Whereas with a limited company, unless you put a personal guarantee in place or you've done some serious wrongdoing, you do have the benefit of limited liability, which means your personal assets are safe. A limited company has directors, and these are appointed by the shareholders. A director's job is to manage the business. They've got directors' duties, which they must adhere to, and they are actually separate from shareholders. So a shareholder doesn't have to be the same as director. A shareholder's role is simply that they own shares in that business. But for quite a lot of small and medium-sized entities, the directors and shareholders are the same people. And a lot of this information is available publicly. So a limited company, each year it must file annual accounts. These go to Companies House and HMRC, and it must also file a corporation tax return to HMRC, a confirmation statement, which goes to Companies House. And a question we get asked a lot is, with a limited company, is it April to April? Is that the tax year? Well, a limited company has a financial year of its own, which is roughly 12 months from when the company was set up, incorporated, unless you've actually changed it yourself or extended the year. A limited company pays tax at 19%, corporation tax at 19%, and the corporation tax return deadline is 12 months from the end of the accounting period. So if a company year end is 31st December 2019, the corporation tax return must be filed by the 31st of December 2020. The tax must be paid 9 months and 1 day after the year end. So in that above example, the corporation tax return must be paid by the 1st of October 2020. So I've always thought it was quite strange that you've actually got longer to prepare your corporation tax return than you do to pay it. So in essence, unless you actually prepared your return by that deadline, there's a bit of guesswork as to what amount of tax needs to be paid. And it's the same with accounting, that you must prepare compliant accounts each year. So they must be prepared under the financial reporting standards, which is a bit of accountancy jargon, which is basically rules that determine how things are accounted for, the presentation of the accounts, just to make sure that all limited company accounts across the UK are kind of similar to one another. Yeah, so any questions, just pop them through and we'll cover those at the end. Perfect. And the accounts must be filed 9 months from the end of the year. So with that previous example of the 31st of December year end, you would have the 30th of September 2020, which is when those accounts must be filed to Companies House by. A confirmation statement is due 14 days from the end of the accounting year when the company was set up. A dormant company. See, a dormant company is different to a trading company. A trading company, you have to do the full accounts, the corporation tax return, whereas a dormant company, which means that you've had no money in or out of the business, it's just not traded. You might have set it up to protect the name or for a business that you've just not got around to starting yet. And what the difference here is that a dormant company does not require full accounts. So you can prepare dormant company accounts, which are very easy to file. They'll probably take 30 minutes maximum if it's the first time doing them, and they go straight to Companies House. There's no requirement to submit a corporation tax return, as long as HMRC are aware that your company is dormant. If, for whatever reason, they think, if they've already sent a CT 600 out, they are expecting a tax return, and as a result, you must inform them that it's dormant. So when it comes to setting up a limited company, here are some things that you should bear in mind. You can use Companies House to do it yourself, or a third-party website. There are many around there. If you simply Google company incorporation, the direct cost of doing it at Companies House, I think it's about £12, or alternatively, you can get an accountant to do it, and their charge may be £100 upwards. Now, here are the key things that people always get wrong when it comes to setting up the company themselves. So do make sure you've got a pen and paper ready. So it's going to ask you the number of shares you want to put when setting the company up. You should keep this as low as possible. So you quite often, it might be £1 or £10. Certainly don't put a high number, because essentially what this means is that you've got more of these shares. So if you've got more shares at a higher nominal value, or if it's £1, that's money you have to put into the company. And the second tip mirrors off the first one, in that do not put a high number, high pound value per share. So keep it at £1, keep it simple, and maybe have £1 or £10 share capital, depending on what you want to achieve. For instance, if you were to put £1,000 share capital, you would actually have to put that money into the company in exchange for the shares. Whereas a better way of doing it would be to keep that share capital as low as possible, and then the rest of the money can go in as a director's loan, which you can charge interest on, as we'll run through later on. It's going to ask you whether you want to use the default articles of association. And if you are setting up a company by yourself or with your partner, then that's absolutely fine to do so. There's no reason to get bespoke articles drafted. Another question we ask is, what SIC code should I use? People often kind of really stress about this and worry about getting this wrong. Whereas my advice to you is it's not that important. The reason for this is because they can be changed within 5 minutes to Companies House. It's very easy to do so. And the changes only take a couple of hours to update and show on the website. But what SIC codes are actually used for? So they might be used as evidence to persuade HMRC that your company is trading rather than an investment. So if you've got development of residential properties, one of your SIC codes, it might be a very, very small piece of the pie that you try to put to HMRC if you want to try and claim some kind of relief that's only available for a trading business, such as previous entrepreneurs relief or rollover relief, something along those lines. But the one that is going to impact most people is just lenders are going to want to see a certain SIC code. This is so that they can see that the company is not trading, there's no other risks involved, that it's just a fresh SPV, which will be used for buying and holding property. So here are some of the main SIC codes. So we've got 68100, which is buying, selling of own real estate. So this is what you do if you were flipping. Then we've also got 68209. So this is the most common SIC code when it comes to holding property, if you're a property investor doing BRI, any of those strategies. And 68320, which is what you might use if you're doing rent to SA and running your company that way. There are a couple of other SIC codes that might apply, but these are the main ones here. This is what you'll see. So when you go to Companies House, if you simply Google Incorporate Limited Company, this is the page you want to start with. So it's register your company. These are the bits of information you'll need. It costs £12 and you can pay via debit, credit card or PayPal. And your company is usually registered in 24 hours. So it's just a case of when you get to that page, register now. It'll ask you a couple of questions which are relatively straightforward. The only complicated ones are around the number of shares, the nominal value, the article of association, which you've just been through. So now you know the best way to approach those. So a lot of people, when they actually set their company up, they're not aware of the amount of information that's in the public domain. So with Companies House, here's a company that we've just pulled off for the purposes of this presentation. And if you're setting your company up yourself, it's something to be mindful of, that your registered office address that you put for your company, that is available on Companies House. So if you put your home address, sort of quite a few questions going through. Yeah, with a slide deck, be yeah, perfect. That's fine because it will be. How do we get rid of that? Perfect. Yeah, so we've got the registered office address here. So if you are setting up your company yourself, look to get your registered office. Look to see if your accountant will allow you to use their registered office, simply because you don't want people going to Companies House. They can Google your name and find out where you live. So you can also see here, we've got incorporated on 9th of October 2007. So as you mentioned previously, your year end is 12 months up to the end of the month upon which you incorporated it. So we can see over here on the left there, we've got their next accounts made up to 31st of October 2019 are due 9 months after that. So that's all relatively straightforward. And then lastly, the SIC code 68209, other letting and operating of owned or leased real estate. That's the only place your SIC code appears. And if you were to update that, that one would be overwritten, and there would be no history of any previous SIC codes. Next, we're going to look at the filing history tab. So you can see here that all of the documents as a PDF which have been submitted to Companies House. Confirmation statements. This is basically where you confirm the shareholders. We've also got the total exempt accounts. So these are the accounts that have been prepared and submitted to Companies House. So this, on the next slide, I've actually just clicked on 8th of July, total exempt full accounts. And this is what they look like. These are the, if this was your company, all of this is available publicly. So you can see here the balance sheet, the fixed assets, tangible assets. So you can see there, tangible assets, note to £780,000. We just skip to the next slide briefly. You actually see note to tangible fixed assets, that company has £780,000 of investment properties. If you also scroll down a bit, so we've got creditors due in 1 year, that's fine. Another big one to look out for is if we go to creditors, amounts due falling after more than 1 year. So we've got note 4 there for £392,000. Note 4, bank loans. So they're going to be mortgages that are secured on that property or properties. And then lastly, we've also got shareholders funds, which is basically the equity. So you've got all of your assets, less your liabilities, all of your assets, properties and cash, less your liabilities, which will be bank mortgages over loans. And then broadly, once all of that has been added up, you can see here the company itself is worth £196,000. So this is what these are the notes. All of these form part of the accounts which get filed at Companies House. One thing to note is that unless you're a very, very large company, your profit and loss won't show, just your balance sheet and the notes. We've also got a people tab. So what this shows is the offices. So this will show the directors and any company secretaries the company has, and persons who have significant control. So broadly, a person of significant control is any shareholder with more than 25% of the shares in the company. So you can see here, Mr. Andreas, he has 75% or more. So it doesn't actually tell you whether they've got 100%. It does it in 25% bandings. So less than 25%, they won't show on the person of significant control register. If it's 25% or 50%, it will show it there, 50 to 75%, and then 75% or more. We can also see the charges register here as well. So where they've taken out a loan and it's secured on a property, so you can see here 52 Abbots Hall Avenue, the lender will put a charge over the property, which basically means that they can't sell it without that charge first being satisfied. So if you are purchasing property or doing due diligence on a potential investor, JV partner, always look at them on Companies House. If they claim that they've got loads of properties with loads of charges, you can go straight to Companies House and see it firsthand. So we mentioned a moment ago about share classes and how we put the number of shares and the value per share. Well, what we're going to do now is run through kind of a way in which you can set your company up or have someone set your company up for you to enable you to pay your dividends flexibly. So if you set your company up and it's yourself and your wife or your partner, for instance, and you own the shares 50-50, what must happen is dividends must be paid in proportion to the shareholding that you actually own. So if we were to declare £50,000 of dividends, you would be taxed on 25%, being 50% of the total dividends that are paid, and your wife would be taxed on 25%. But the issue with this is that someone in the household, so you might be a higher rate taxpayer or your wife might be a higher rate taxpayer, which would result in them paying 32.5% tax on some of their dividends, or even 38.1% if they're an additional rate taxpayer, whilst you might have all of your basic rate band free, which means you'd only pay tax at 7.5%. And even then, if they might have other dividend income, so you might lose the £2,000 dividend allowance as well. And the best way to get around this so we can take dividends flexibly is to have different classes of shares. So what we'd do is we'd say shareholder A, so you would have A shares, and then shareholder B, your partner, would have class B shares. And then what that enables you to do is, say for that £50,000 dividend, you might say, okay, great, I'll take £40,000 of that because that's how much is left in my basic rate band. And then you might give your partner, your spouse, £10,000 on the class B shares. And overall, that means that you've not had it done 50-50, and you don't risk paying tax at 32.5% of those additional rates. However, it's quite complicated because when we mentioned previously that you can use the default articles of association, when you have a company with multiple share classes, you have to get them draft bespoke articles of association. So I wouldn't recommend doing it yourself. Speak to an accountant. It does cost about £350 to set it up in the get-go, but it will likely save you thousands of pounds in tax each year. So that's a very small price to pay. So I'm also going to run through group structures. So when you set your company up originally, say for instance, it's you at the top there, and you might have a trading company, you might have an investment company, or a SPV, a property that you might be doing a development in, any other kind of limited shelf life business transaction. So what would usually happen is if you've got a trading company, it generates profits, it's generating cash flow. This could be a rent to SA business, a typical trading business, anything that generates cash flow monthly and you use it to fund your lifestyle. However, once it gets to a certain size, you're going to look to reinvest those profits and actually purchase assets, purchase properties. Traditionally, the way this is done, especially for a lot of people, is that they have an investment company. And what the investment company does is it buys the assets, and the way we get the funds from the trading company to the investment company is via a loan. Because if we were to take the money out of the trading company, we would have to pay income tax on that as a dividend or a salary, which you don't want to do. We just want to transfer over. However, this structure has a number of flaws to it. The biggest one is that those loans have to be repaid. If they get written off, it would potentially give rise to a tax charge in the trading company and a loss in the investment company, which would mean overall, given that you own the shares in both of the companies, you would likely be out of pocket a large amount of tax on the loan balance that's repaid. And there are certain other benefits to actually having a group structure in place, as we're going to run through now. So instead of you owning the shares in each of those companies, you actually own the shares in a holding company. And in turn, it's that holding company which owns the shares in all of those subsidiaries. You might have a trading company here, an investment company. What happens is the trading company generates cash, that gets paid as a dividend up to the holding company. And in turn, that holding company loans it down to the investment company. The advantages to having it structured this way are that you can move property around tax-free. You can actually sell that trading company tax-free due to something called the substantial shareholders exemption, which is a fantastic relief. So if you sold that trading company for £500,000, your holding company wouldn't pay any tax on that, and your holding company would have £500,000 cash in its bank account. In addition to this, you can move properties around with no stamp duty. So as you venture into developments and things like that, you can actually move them from your development company to your investment company very tax efficiently. And eventually what happens is you would add to this over time if you might do an SPV. So if you did a single development, for instance, you could set up an SPV and then the money goes back to your holding company as a dividend, and it's very tax efficient and gives you the most post-tax cash to go again. This is kind of how complicated it would get, in that you have a holding company, SPVs, joint ventures. But the key here is that you own 100% of the shares in the holding company, and all of your different business interests will actually come off of that holding company. And that's the most tax efficient way to structure it for a lot of people, based on their business plan, the amount they want to scale to, and whether it's worthwhile paying that little bit extra to get this set up at the early stages. Okay. So when it comes to running a limited company, this is just a bit of good practice. So definitely try and have separate bank accounts for as much as possible. Certainly have a separate bank account for your business and your personal transactions. And for each different business you have a separate business bank account. I'd also suggest budgeting for tax. So have a separate account, that's your savings account, your tax account. So you know that when it gets to the end of the year, you've got the money there and there are no nasty surprises coming your way. We'd say budget around 20% of your monthly profit for corporation tax, simply because this will usually slightly overcompensate, which means that you have a little bit of change left over. Also remember, it's your duty to keep good quality records, and HMRC actually have the right to fine you up to £3,000 if you fail to do so. Another big one is, don't just take money out of your company as you wish, because if your director's own account becomes overdrawn, there's a potential for a 32.5% tax charge. We'd always recommend looking to go digital. So you can't really run a business very well just using Excel spreadsheets. Get set up on Xero or QuickBooks, because they will really help you track your numbers. Receipt Bank is fantastic. I go on about it a lot, because what it will do, you don't need receipts. You just take a picture. You can forward email invoices. You can even pull receipts from from Amazon. It pushes all that over to Xero, and it's a really quick and easy way to stay on top of your numbers. Additionally, TripCatcher and MileRQ are fantastic, because what they do is allow you to track your mileage. So they use your phone's GPS location, and then when it gets to the end of the day, end of the week, you can simply swipe left or right. That's whether it's a business trip or a personal trip. Then at the end of the year, you send that over to your accountant, and you know that your mileage is 100% accurate. This is just what a profit and loss looks like from Xero. So Xero is the accounting software that we recommend. But simply because it's so quick and easy to use, and it gives you the information you need. So if this were your company, you could literally pull this report, a click of 1 or 2 buttons, and it gives you exactly in pounds and pence what your sales are, what your purchases are. You can see exactly where your money's gone, and this works in any business. So if you're a property business, you can see what your monthly rent roll is, how much the agents are taking, what your mortgage interest is, and you can set this up to actually give you a report on a per property basis. So if you've got more than one, or if you've got a HMO of different rooms, you can really drill down and get the numbers you need. We've also got a balance sheet as well. So there's 2 primary financial statements that we need to look at. First is the profit and loss. Second is the balance sheet. On the profit and loss is where your income and expenses are recorded. On the balance sheet is where your assets, liabilities, and your equity or your capital are recorded. So you can see here that tangible assets, that might be properties, computer equipment, office equipment, investment properties. Current assets, so these are short-term assets that are expected to be realized to cash. So you've got cash in the bank, because cash is cash. Accounts receivable, so if you were given items on credit, that would be a debtor, and that would be a current asset. You can also see here, creditors, director's loan account, £85,000. Now that's a good position to be in, because what that means is the company, so your company owes you £85,000, which can be taken out tax-free, and you can charge interest on, as we're going to run through a little bit later on. So my top tips for when it comes to staying on top of your limited company accounting is just put time aside to do it. 1 day a month for a lot of businesses should be more than enough. Also record absolutely everything. So any money into the company, any money out of the company, and always check with your accountant before doing something, because it's so much more expensive to fix something that's gone wrong after it's happened. If just pick up the phone to your accountant and say, hey, I'm thinking of doing this. What's the downside? What are the risks? Have that chat before you do it, because they might kind of steer you in the right direction, which could potentially save you a lot of money later on. So we're just running through business expenses now. There's a lot of people ask me about kind of tax relief and what it means to kind of claim it back for tax. And fundamentally, I think there's a bit of a confusion between the way kind of corporation tax and profits work to VAT. So when it comes to corporation tax, you never really claim anything back with VAT. If you're a VAT registered business, you do claim the VAT back. But for corporation tax, it doesn't quite work like that. It doesn't usually produce a rebate of tax. It only lowers the amount of tax due. So if you have more expenses you do income, you've got a loss. And what happens with that loss is it gets carried forward to the next year and set against any future profits you might have. So for instance, if this year you made a loss of £5,000, next year you made a profit of £15,000, before paying any tax on that £15,000, we'll go, hang on a minute, do we have any losses from previous years to carry forward? And go, okay, yep, last year we made a loss of 5,000, we'll take that off of the 15. So this year we'd only pay tax on that £10,000. The only time it would produce a repayment of tax is if you had previously, if you had profits upon which you had previously paid tax. So say for instance, we had £50,000 worth of profits last year. We've now got a loss of £25,000 this year. Only in that case, we can actually carry that back to last year and ask HMRC for a refund of tax we paid last year. So what expenses can be claimed? Essentially, expenses can be paid from the company's bank account, or directors can be reimbursed when they pay for them personally. So I love doing this. I love collecting Avios points. So for as much as possible, I always put it through on my British Airways Avios card, and then get the company to reimburse me so I get my air miles. Another thing to note is that it must be wholly and exclusively incurred, so it can't be any personal benefit to you. It must be for the purposes of the business. If you personally benefit, a deduction for tax isn't usually available, or there might be a benefit in kind charge, which is usually best to avoid. So one thing that you can claim is accommodation on business travel. So if you're going for training days, if you live quite far away from your gold mine area and you're going there to view a series of properties and you might stay the night, as long as you any personal enjoyment is incidental and the main purpose of the trip is for business related purposes, you can claim that as a business expense. But it must be reasonable and not excessive. So if you don't usually travel and stay in the 5-star best hotels, the Ritz, then if you were to do so at that one time at the expense of the business, HMRC are likely to challenge that and say it's excessive. Parking, so visiting properties, clients, your accountant, if you have an office or a shared office, parking near that is also an allowable expense. Business mileage, to travel for business purposes, anything that's got a business purpose to it, so viewing properties, training, visiting your accountant. It's important to keep a tracker of all of this using MyLucky or TripCatcher, because it's actually 45p a mile you can claim where you're using your own vehicle for business purposes. So 10,000 miles, that's £4,500, which is going to come off of your tax bill and actually increase your director's own account if you've not been reimbursed that. So that's an extra £4,500 you can bring out of that company completely tax-free. After this, it's 25p a mile, but it's very important to keep detailed records showing where, when, and why you went on that trip, just in case HMRC ever come along and do query this. So also we've got annual events. So if you're a limited company, it's £150 per year per individual, and it can be 2 or 3 separate events or one big one. And this is also a benefit of having a partner or wife as a director, because then you get double the benefit. Realistically, this could be 2 or 3 decent meals out a year, and it's a fully allowable expense for the company, and there's no tax charge on you as an individual, which can be a very fantastic and tax efficient way of taking your partner out at Valentine's Day if you coincide it with an annual company event. We've also got trivial benefits. So these are kind of non-work related gifts to an employee or director. So you can gift it to yourself, because a limited company and you, separate legal people, as we mentioned earlier, legal entities. The conditions are that it must cost less than £50, isn't a cash or a voucher which is redeemable for cash, it's not a reward for work, and it isn't part of the contract. But for director and shareholders of their own business, it's capped at £300 a year. So really, this is just a case of every couple of months, you can just use the company debit card to buy yourself an Amazon voucher, a John Lewis voucher, anything, as long as you can't return that voucher and get cash back, and it's completely tax-free, you can get it's a tax allowable expense in the company, and it's a great way just to pull out a little bit of tax, a little bit of money out of the company and save some tax. If you've got 2 directors, we can double up on this, which means it's £600 a year that we can pull out tax-free and also get a corporation tax deduction for. Mobile phones, so you can get 1 mobile phone per director. It's a fully tax allowable expense in the company, and there's no tax on you personally. However, it must be in the name of the company. So you can't have your previous agreement if you've got a contract phone or a SIM-only deal where you're locked in, and you've got a monthly tie-in. That needs to be in the name of the company in order for it to be an allowable expense. But if you own your handset outright, you can sell it to the company, and that will increase your director's loan account because you've sold something to it. So if you've got an iPhone 11 and you sell it to them for say £800, which is realistically what one might be worth, that increases the amount of money that your company owes you, and the company will be able to get some tax relief on the actual handset cost. We've also got laptops and iPads. So these are a fully allowable expense again for the company. You get capital allowances, which in effect result in that it being taken off of your taxable profits. One thing to note though is that unlike mobile phones, a laptop and iPad, if they're significant private use, if you use it a lot for your own purposes, it may give rise to a taxable benefit in kind. Now, I've not got time tonight to run through what one of those are and the implications, but essentially it's usually costly from a tax perspective, so let's try and avoid it. However, to date, there are no cases of HMRC going after people for using the company iPad a little bit too much, but it's just one thing to note. And also we've got the home office. So for this year, it's £6 per week is what you can claim as a flat rate, where you're using your home office, a room in your office for your business purposes. You don't need to keep any records of this, which is great. It's a nice, easy way, and it's a great tax deduction. Alternatively, you can claim a proportion of your household expenses, but this requires detailed calculations of the all of your annual bills, the size of your house, the rooms, how much you're using it for business purposes. Or alternatively, you can rent a room to your company, and this also requires a rental agreement, and there might be some other tax implications, especially around capital gains tax where you own your property. Your accountant will certainly be able to help with this, so just speak with them about getting this set up. A big one we get asked is training. So what training can be an allowable expense? Whereas it's certainly our view that because with property, there's no set barrier to entry. Anyone can kind of become a property investor without going on any of the courses. That property training course is an allowable expense because it just relates to updating knowledge. But if you are spending a significant amount of money on training, we recommend having your company set up and at least trade in with properties, so you can evidence that you are a property investor before paying for any significant property training courses, just so that you're 100% in the best position should HMRC ever come along and challenge these. So now your company's generating money and you've got excess funds and you want to bring them out, what's the best way to look and getting that in place? So interest, this is where your company owes you money, your director's loan account. You can actually charge interest on that. And the advantage of this is that it's tax deductible within the company. So it comes off of your taxable profits, and it can be received personally by you very tax efficiently. So if you're a basic rate taxpayer, there's £1,000 a year, which can be received tax-free, called your personal savings allowance. And indeed, if you're a basic rate taxpayer for the rest of your income, you'll actually only pay 20% tax on the rest of that interest income up until you go into the next banding, simply because you don't pay any national insurance on interest income. One thing to note is that you must charge a commercial rate. So with this, the scope is quite wide ranging, because if you're loaning money to your company on an unsecured basis with minimal payment terms, you could get away with charging anywhere between 5% up to 15%. And what we can actually do is engineer a rate to give you the most tax efficient amount of income. The second best way of taking money out is a salary. So if it's just you on the payroll of your limited company, we recommend taking out about £9,500 a year. If there are others on the payroll, it might be £12,500 a year. This is due to something called the employment allowance being available. Taking any more than these amounts is generally not tax efficient because you pay income tax, plus employee national insurance, plus employers national insurance, which overall makes for quite an expensive tax rate. Lastly, we've got dividends. One thing to know is that a company must have profits, so it must have made money. It can't have made a loss. You can't pay dividends out of a loss. If not, this would be deemed an illegal dividend, and it could need to be repaid or treated as a salary, and which would result in additional tax being due. And dividends are always paid after having paid corporation tax. So just because you've made this profit of £100,000, that's not the amount of dividends you can take. Remember, you've got to deduct 19% of tax on that. Dividends are taxed as follows. So you get your first £2,000 tax-free of dividends, no matter if you're a higher rate, basic rate taxpayer. After this, it's 7.5% where they fall into your basic rate band. Then it's 32.5% for a higher rate, up to 38.1%. The most tax efficient mix of salary from your limited company is going to drawings is going to be a mix depending on your personal circumstances. It's usually tax efficient to take about £50,000 a year out. Anything more than this, and it does start to add up. On a £50,000 of earnings, the average tax rate is give or take 23%, which isn't too bad in the grand scheme of things. Anything more than this, and it really does start to increase to 40% and more based on the more income you have and the more you take out. Because of this, it's quite effective to live modestly whilst building wealth in the company so that you can reinvest the proceeds and really accumulate serious wealth whilst paying the least amount of tax possible. So with a director's loan account, essentially, when you loan money to the company, so that £85,000 on the previous slide we saw a couple of slides back, that's a director's loan account. It's best if you're going to loan a significant amount of money to your company to get an agreement drawn up. And then this allows you to charge interest at a rate we previously mentioned. And with this, you can withdraw it out tax-free, or even if you don't actually have the cash to pay it right now, you can increase your director's loan account. So if we were to charge £5,000 worth of interest, rather than that being paid cash to the bank, what we can actually do is we can increase the director's loan account. So now the company owes you £90,000. This will save you tax during the year and also increase the amount you can later take out completely tax-free. And then we can do this each and every year. One thing to note is that when you are paying interest, there's a form that needs to be filed. It's called a CT61. Your accountant will be able to do this for you. But we often see where a lot of people forget to file this form. And unfortunately, there is a risk that you will get a penalty if you don't do so. So I'll just blitz through that quickly. But what we've got now is plenty of time. So if I stop the screen share, let's just go through all the questions. So I had quite a few come through now. But if you've got any more questions, pop them in the comments now so we can run through those because you've got quite a bit of time left. Yeah, so will the slide deck be available after the webinar? Yeah, it certainly will be. What I can do is I can email these around to people. If that'd be great. If anyone would want to copy the slides, let me know and I'll email them over to you. Do you do? Yeah, absolutely. Yeah. So do you do the whole limited company setup? Yep. So we do this. We can do this for you. Our cost to set up a limited company for a property SPV, we charge. It's just £100 plus VAT to set up a new limited company. Cool. So we've got more. Yeah. Perfect. Colin, I'll get that sent over to you. Parthos. Okay. Currently. I want to grow my portfolio. This man to both. Yeah, so actually I'll read the question out. So essentially we've got somebody here who's employed with a gross salary of around £21,000 and a small property portfolio, which is mainly buy-to-lets and HMOs. All of these are brought under their sole name. So they're transferred 50% of some of the properties to their wife's name just for the tax benefit. The wife's only income is a profit from the HMOs and nothing else. The long-term goals are to grow the portfolio in this manner until we both get around 50k to live off, as we need in rental income. Also, if we share the 50k, then Section 24 will not affect us. After we exhaust this, we will start to buy in the limited company, as we can leave the profit in the company and do not have to take any money out, making it tax beneficial. Yeah, Absolutely. So that's a fantastic kind of way of doing it. This is where a lot of people kind of jump into a limited company where maybe it's not the best thing to do so. So based on your current circumstances, you've actually got £50,000 each to live off. So yeah, you both get £50,000 each. So in total, as a household, you can get, give or take, £100,000 a year in rental income before Section 24 actually starts to impact you. Assuming that you leave your employment, so no other employment income, just property income, you can get £100,000 a year without there being any significant impacts of Section 24. So if that's what you want in the long term, £100,000 a year, then you probably won't actually ever need to get a limited company involved. You could simply just keep buying in your own name until you hit that ceiling, and then kind of call it a day and just live off the rental income. If you do want to grow significantly beyond this and acquire a number of more properties, then yeah, certainly a limited company might be the best thing to do, because as you go in the higher rate band, you'll start paying tax at 40%, and Section 24 will really start to kick in. Yep, so can a holding company be set up as an LLP instead of a limited company? Yes, it can, but I think off the top of my head, it doesn't have the benefit of the capital gains group relief. I think it can work for a number of other reliefs, especially the stamp duty relief. But with dividends, I don't think it also benefits from the dividend exemption. So it can in certain circumstances, but some of the benefits of having a limited company as a holding company are actually drawn back where you've got an LLP. Yeah, so for clarity, 681, buying and selling of real estate means a trading company. Yeah, exactly that. So you can either, depending on the scope of flipping you were doing, and if you're doing substantial refurb work, that SIC code 68100 will be suitable for that. Essentially, it's where you're buying and selling of real estate. If you do a light amount of refurb, that's fine, but it's a property trading company, which means that you won't be holding the property for long term. You won't be buying all the properties on mortgages. You'll be having short-term finance, whether that's bridging finance or cash purchasing, because you know you're going to sell it on, so you don't need a long-term financial product for that. So what are the tax benefits of purchasing a property in a limited company? So for me, the biggest one is it allows you to control how much tax you want to pay in some respect, in that you know for a fact that you have to pay 19% corporation tax. But if you leave the money in there, that's all you're going to pay. Whereas if you were to draw it out personally, or indeed have property in your own name, if you earn more money one year, you might get a bonus, you might have a couple more properties. All of a sudden, you're going to get pushed into the higher rate bracket, which when you start paying tax at 40%, and then also essentially you get less tax relief in your mortgage interest. Those Section 24 really kicks in, and you only get a 20% tax credit. So for me, that's the biggest benefit, is that you can reinvest a lot more of your proceeds, especially if you've got a job that you enjoy or you've got your own business and you don't actually want property income. You don't want the money to live off now. You want it as later on down the line. You're trying to build it up in the sideline for later on. That's where I think the real benefit to having your limited company holding the property is, because you pay 19% corporation tax, you can reinvest the proceeds, and you're continually doing so each and every year. So I've got, I want to take a director's loan from my consultancy business, which is cash in the bank, to fund the startup of a new limited company. Would it be better to set up a holding company instead and move the money to the holding company and then move it down to the limited company? Yep. So yeah, so if you've already got a overdrawn director's loan account, well, if you've got a balance essentially, so as long as you don't go overdrawn with the money you're borrowing from the consultancy business, that's fine. As long as if a existing director's loan account is being repaid, that's okay. But if for instance, if it's a clean slate at the moment, you owe the company nothing, the company owes you nothing, then you would take £100,000 out of profits, retain profits from the consultancy business, to then invest into property or invest in a new limited company. That's where that 32.5% tax charge will kick in, because you would end up owing your company £100,000. So definitely try and avoid that if possible. That's not a good thing to do. One thing that is fantastic for people in this circumstances like yours, if you've got a trading company at the moment, so your consultancy business, what you can actually do is something called a share for share exchange. So yeah, pretty would get a pen and paper just in case. It's a share for share exchange, and what it enables you to do is it enables you to insert a group, so a holding company in place. You simply you swap the shares around, and the end result is that we have a holding company at the top now, and then your consultancy business as a subsidiary underneath, which runs back to that slide where we had the good holding company, where you got your trading company, and then dividends go up to your holding company, and then you loan it back down to your property SPV, which is going to buy and hold property. So definitely look at getting one of those set up, because that's likely going to be the most tax efficient way to structure all of that, Colin. Perfect. So yeah, thanks for clarifying regarding 68100. But mortgage lender seems happy with this code for SPV long term. Yeah, they're not too fussed about that. If they know it's a freshly set up company, there's no trading history to it, they're not really impartial. They don't really care too much about SIC codes, but it's just a small little indicator to them. Some lenders are quite anal about that. They will want to see a certain SIC code. Others may not, depending on what finance product you're getting out, and how comfortable they are with the actual property and the deal itself. So that's not a massive issue. Perfect. Do you have any more questions at all, guys, before we call it a day? I'm happy to stay on for as long as possible just to make sure everyone's got all their questions answered. Any more questions, anyone? If not, what I'll do actually is, let me share my email. I'll put my email address in the comments here. So if anybody does, I appreciate that there's a lot to digest at the moment. Do you offer one-time consultancy? How much is the charge? Yeah, so it depends what it's for, but usually, so if we have a 1 hour consultation, which is essentially we do a quick review of your circumstances, and we can advise you over the phone. So there's no written advice for that, but that's just 197 plus VAT. So that's a telephone consultation where we answer any questions you've got. We have up to an hour on the phone, so we can really go through your circumstances. We can go through some calculations if we're able to do those quickly. That's the best one if it's just a one-off consultation. If not, we'll have to look at your circumstances, and the price depends on what it's for. So if you send me an email, then we can give you an exact price. But yeah, prices starting from 197 plus VAT for a full consultation. Perfect. Yeah, so I've got my email address there. So any questions at all, guys, just ping me over an email. I'm more than happy to help. I'll also send a copy of the slides and a recording of this webinar to everybody so that you can go through it at your own time, because I appreciate there's a lot to take in and I talk quite fast sometimes. Yeah, cool. There's some more questions come through. What is the most appropriate SIC code for long-term investment? That's the 68209 one. Let me see if I can find that slide. It was 68209. Yeah, 68209, other letting and operating of owned or leased real estate. That's the most common SIC code, and pretty much every single lender out there is going to accept that. Bank accounts for a good bank. So yeah, I recommend Starling are pretty good. I've had accounts with them. Tides are pretty good also. Recently, I've just set accounts up with HSBC, simply because when you are looking for a more tailored service, all the online ones, they're kind of quite set in the way they work. Whereas if you want accounts set up quickly and you've got holding companies in place, for instance, Starling don't accept holding companies. Tide do, but sometimes they just decline your application for no reason. So I've had to start going now to the high street banks such as HSBC or Barclays, because those guys are used to dealing with holding companies, and they don't have any issues with that. So for rentals and flips, VAT does not apply, right? Yeah, absolutely. So if you're doing anything that's residential property, really, there's no VAT. The only time that you need to consider it is if you're doing development, so ground up or conversions, there might be some VAT opportunities there. But when it comes to doing a BRR project or a flip, you're going to pay VAT on all the materials, and you don't have to charge VAT. So it's just not something to worry about. It simply doesn't apply as exempt. Is it a good idea to set up the holding company as LLP? I'd say not, unless there's any real. I very rarely see the benefits of having the holding company as an LLP. Depending on the level of income you've got, and if you are looking to bring on quite a few different people, and there's a serious wealth in the company, maybe. But usually, I think a limited company is going to give you a better result, as there are a few more reliefs that apply. Okay, yeah, Luke, so you can't see the email address. It's in the comments box, but what I'll do is, if you, let me share the last screen actually. Can you see it there? Just share my screen again quickly, and then you'll see my email address there. Yeah, so there's my email address there, guys. So it's joshua@jsmpartners.co.uk. And yeah, I know you guys are on this webinar, so if you've got any questions at all, ping them an email and I get those answered. Usually if someone used the email is asking me a question, we put a consultation fee there. But since I know you guys are on this webinar, I'll get those answered for you at no additional cost. So joshua@jsmpartners.co.uk. I'll stop sharing my screen again now. Any more questions coming through? Can I use more than one SIC code for the company, say 6800 and 68209 together? Any drawbacks? I'd counter that and say, what are the benefits? You know, there are no benefits to having more than one SIC code. Essentially, the only time it's used as a kind of small indicator to HMRC, as long as the lenders accept it, that's fine. It's not a worry. They're going to accept 68209. And as you say, you know, some accept 68100. With HMRC, they're going to want to look at the actual substance of the transaction. So if we wanted to try and claim some kind of relief, you know, gift relief, entrepreneurs relief, any of those reliefs that are only available to a trading business, they're going to want to look at the accounts. They're going to want to see the actual substance of it. So a SIC code in those cases won't make any difference. So I'd just say, keep it simple, have just the one, unless you are really looking at doing property investment and then property trading in the same company, which is a whole different issue, and you probably should look at separating them out. If not, just to make sure that you preserve some reliefs, such as entrepreneur, business asset disposal relief, gift relief, that apply to a trading business. Do you need to do annual accounts for a holding company? Yep, you do. But the good news is, so most accountants, I know we certainly do, we actually charge 50% of the annual fee for what we would for a normal company, for a holding company, to recognise the fact that they are incredibly simple to do the accounts for. All that there is literally just dividends from trading companies up to the holding company. So dividends received, then money lent back down. That's usually the only transactions that go through a holding company account, but we still do need to do the full accounts and a tax return for them, just to tell HMRC that we received dividend income, but it's exempt. Perfect. So any more questions at all, guys? Thanks for clarity. Yeah, my pleasure. Yeah. Okay, perfect. So what I'm happy to do, guys, I'm happy to call it an evening. If you get any more questions at all, you've got my email address. Otherwise, I'll send the recording out and the webinar slides for this. What I could also do is, even if you don't have any questions, if you've got any feedback about tonight's presentation, please do just send it to my email address, joshua@jsmpartners.co.uk, just to say, yeah, great webinar, or not so good. I've got thick skin and I'm always open to feedback. So that's all for me, guys. Thank you very much. And I hope you enjoy the rest of your Sunday, and I catch up with you all soon. Bye, guys.